Good evening. On a single trading day that most investors will remember for months to come, silver mining stocks surged by 8.3%. This was not a gradual climb. This was not the result of patient accumulation. This was a gamma squeeze in action. If you hold positions in precious metals, if you've been watching the silver market with interest, if you're trying to understand what just happened and what it means for your portfolio, you need to pay close attention to what comes next. Because what we witnessed was not simply a good day for silver miners. It was a textbook example of how options market mechanics can create explosive price movements that catch the majority of market participants completely unprepared. And here's what matters most. The aftermath of such events often holds more importance than the event itself. Today, we're going to examine exactly what occurred. We'll look at the mechanics that drove this movement, we'll explore what it signals about the broader precious metals market. And most importantly, we'll discuss how you should respond, whether you're already holding these assets or considering entry. This is not about celebration. This is not about fear. This is about understanding and preparation. Let's begin. First, we need to establish what actually happened. A gamma squeeze occurs when options market dynamics force market makers to rapidly adjust their hedging positions. This creates a self-reinforcing cycle that accelerates price movement in one direction. Here's how it works in plain language. When you buy a call option on a stock or ETF, someone has to sell you that option. Usually that's a market maker. These market makers don't want to take directional risk. They want to remain neutral and profit from the spread between buying and selling options. To stay neutral, market makers hedge their options positions by buying or selling the underlying stock. The amount they need to buy or sell changes as the stock price moves. The sensitivity to price movement is called gamma. When a stock starts rising and many call options move closer to being in the money, market makers must buy more shares to maintain their hedge. This buying pressure pushes the price higher, which forces them to buy even more shares, which pushes the price higher still. This is the squeeze, and it can happen remarkably fast. In the case of silver miners, we saw this mechanism activate with considerable force. An 8.3% single-day move in a sector index is significant. For context, that's the kind of movement that typically takes weeks or months to develop through normal supply and demand dynamics. But gamma squeezes are not normal dynamics. They're technical events driven by the options market structure itself. Now, why does this matter to you? Because these events reveal something important about market positioning. They show us where leverage has accumulated. They demonstrate which assets have attracted speculative interest, and they often serve as catalysts that change the broader narrative around a sector. Let's zoom out and examine the context in which this squeeze occurred. Silver miners have been in a complex position for several years. They operate in an industry with high operational costs, exposure to energy prices, and significant capital requirements. Their leverage plays on the underlying commodity. When silver moves, miners typically move more, but they've also faced challenges: rising production costs, jurisdictional risks, competition for investment capital with other sectors offering clearer growth narratives. For much of the past few years, investors have favored technology, artificial intelligence, and growth stocks. Commodity producers have been out of favor. Capital has flowed away from materials and mining. This created an interesting setup: low institutional ownership, minimal retail enthusiasm, compressed valuations, and very light positioning in the options market. Then something changed. Perhaps it was growing concerns about monetary policy. Perhaps it was renewed interest in inflation hedges. Perhaps it was technical factors as silver itself broke through key resistance levels. Or perhaps it was simply the recognition that these stocks had become too cheap relative to their operational performance. Whatever the catalyst, options activity began to increase. Call options were purchased. Implied volatility started rising, and the conditions for a gamma squeeze were set. When the move finally came, it came fast. This is how markets work. They remain quiet for extended periods, and they move violently in short bursts. The majority of returns are often compressed into a small number of days. If you were positioned for this move, it felt wonderful. If you were waiting for a pullback to enter, it felt frustrating. If you were short these stocks, it felt devastating. This event in silver miners does not exist in isolation. It's occurring within a specific macro environment that deserves examination. We're in a period of elevated uncertainty across multiple dimensions. Central banks are navigating between inflation concerns and growth concerns. Geopolitical tensions remain elevated. Debt levels across developed economies continue to climb. And trust in traditional financial institutions shows signs of strain. In such environments, hard assets historically attract renewed attention. Gold and silver have served as stores of value and monetary alternatives for thousands of years. This is not superstition or outdated thinking. It's pattern recognition based on how human societies respond to monetary instability. When investors grow concerned about currency debasement, they often rotate toward precious metals. When they fear systemic financial stress, they seek assets that exist outside the traditional banking system. When they worry about inflation, they look for tangible stores of value. These rotations don't happen overnight. They develop gradually, then accelerate suddenly. The gamma squeeze in silver miners may be an early signal of such a rotation beginning, or it may be a false start, followed by consolidation and disappointment. We cannot know with certainty. What we can do is observe, analyze, and position appropriately based on probability and risk management. Let's talk about the psychology of rapid price movements, because this is where most investors make their greatest mistakes. When you see a sector jump 8.3% in a day, your brain activates in specific ways. If you own these stocks, you feel elation, vindication, the temptation to check your portfolio repeatedly, the desire to tell others about your success. If you don't own these stocks, you feel something different: regret, fear of missing out, the urge to chase the move immediately before it runs further away from you. Both reactions are natural. Both are also dangerous. The investor who feels elation may become overconfident. They may add to positions at extended levels. They may increase leverage. They may abandon their disciplined exit strategies, believing the good times will continue indefinitely. The investor who feels regret may enter positions impulsively. They may ignore their usual risk parameters. They may buy at the worst possible moment right before a sharp pullback. This is why markets can inflict the most damage right after they've created the most excitement. Understanding this psychological pattern is perhaps more valuable than understanding the gamma squeeze itself, because gamma squeezes will happen again in different sectors at different times, but the psychological traps remain constant. The skilled investor learns to recognize these emotional patterns in themselves. They develop systems and rules that prevent emotion from driving decisions. They understand that spectacular one-day moves are often followed by consolidation, volatility, or reversal. This discipline separates those who build wealth over time from those who ride emotional roller coasters to nowhere. History provides useful perspective here, even though it never repeats exactly. We've seen explosive moves in precious metals and mining stocks before. In the early 2000s, gold and silver miners delivered extraordinary returns over several years. In 2011, silver itself experienced a parabolic rise followed by a devastating collapse. In each case, the moves were driven by a combination of fundamental factors and technical dynamics: monetary expansion, currency concerns, speculative fever, and yes, options market mechanics accelerating the moves beyond what fundamentals alone would justify. What lessons can we extract from these historical episodes? First, rapid moves tend to overshoot in both directions. Markets don't politely stop at fair value. They surge past it, then correct back, often below it. Second, the best entries typically come before the explosive move, or during the consolidation after it. Chasing the move itself usually produces disappointing results. Third, these sectors can remain in uptrends for much longer than skeptics expect, but they can also reverse with shocking speed. The volatility cuts both ways. Fourth, narratives change. What seems obvious and inevitable during a surge often looks foolish during a subsequent decline. The story adjusts to fit the price, not the other way around. These patterns don't provide exact roadmaps, but they provide frameworks for thinking probabilistically about what might come next. And that's what intelligent investing requires. Not certainty, not predictions, but probabilistic thinking combined with robust risk management. Now let's get specific. If you currently hold silver mining stocks, what should you be thinking about? First, acknowledge that you've just experienced a significant favorable move. This is good. But it also changes your risk profile. Positions that were small and speculative may now be large enough to impact your portfolio. Gains that were unrealized are now real, at least on paper. Your primary task is to protect what you've gained while remaining positioned for potential further upside. This means reviewing your position sizes. If silver miners have grown from 3% of your portfolio to 7% due to appreciation, you need to decide whether that's still appropriate. If not, consider trimming positions back to your target allocation. This is not about predicting what comes next. This is about maintaining portfolio discipline regardless of what comes next. Second, consider implementing trailing stops or option-based protection. If you've made substantial gains, there's nothing wrong with locking in a portion of them while staying exposed to further upside. Trailing stops can automatically exit positions if they fall below a certain level. Put options can provide insurance against sharp declines. These tools aren't perfect. They come with costs and complications. But they're far better than riding a position all the way up and then all the way back down simply because you couldn't bring yourself to take action. Third, resist the temptation to add to positions impulsively just because they're working. The time to build positions is when assets are unloved and cheap, not after they've just surged 8% in a day. If you believe the fundamental case for silver miners has improved, by all means consider adding to positions. But do so methodically. Scale in over time. Wait for pullbacks. Don't let excitement override discipline. Fourth, review the specific companies you own. Not all silver miners are created equal. Some have better management teams, lower costs, stronger balance sheets, and superior assets. An 8.3% move may have lifted all boats, but when the sector consolidates, quality will matter again. Use this moment of elevated attention to reassess your holdings. Are you confident in the companies you own? Do they have the operational excellence to thrive in various silver price environments? Or did you simply buy the most volatile names hoping for quick gains? Finally, prepare yourself emotionally for what comes next. And what comes next is likely to be volatile. After explosive moves, markets rarely continue straight up. They consolidate, they pull back, they shake out weak hands. This is normal and healthy. If you've protected your gains and maintained reasonable position sizes, you can weather this volatility without panic. But if you've let positions grow too large, or if you've added aggressively at elevated prices, the volatility will be harder to tolerate, and that difficulty will lead to poor decisions. If you don't currently hold silver miners, but you're interested in the sector, your situation is different. Your biggest advantage is that you can be patient. You don't have to do anything. You can watch, wait, and allow the market to provide a better entry point. Because after an 8.3% surge, the probability of an immediate continued straight line move higher is low. Possible, but low. More likely is consolidation, pullback, or sideways movement as the market digests the gains. This consolidation phase is when patient investors should be paying attention. Look for several things. First, watch how the sector behaves on down days. Does it hold support levels? Does it give back gains slowly or rapidly? Strong sectors consolidate with discipline. Weak sectors collapse back to where they started. Second, monitor options activity and implied volatility. If implied volatility remains elevated after the initial squeeze, it suggests continued speculative interest and potential for further squeezes. If it drops back to normal levels, the excitement may be fading. Third, assess the fundamental backdrop. Is the interest in silver miners being driven by durable factors like monetary policy concerns and inflation hedging, or is it purely technical and speculative? Durable drivers support longer trends. Pure speculation creates sharp moves that reverse quickly. Fourth, consider your portfolio context. Where would silver miners fit? What role would they serve? How large a position makes sense given your overall risk tolerance and investment objectives? These are not exciting questions, but they're the right questions. If you decide to build a position, do so gradually. Start with a small allocation, perhaps 1 or 2% of your portfolio. Scale in over weeks or months, not hours or days. This approach ensures you'll never buy at the absolute worst price, and it prevents a single bad entry from defining your entire experience with the sector. Consider both individual mining companies and sector ETFs. Individual companies offer higher potential returns, but also higher specific risk. ETFs provide diversification and simplicity at the cost of potentially lower returns. There's no universal right answer, but there is a right approach, thoughtful, measured, and aligned with your specific circumstances. One more critical point for potential investors. Do not feel pressured to act immediately. The financial media will create urgency. Social media will be full of people claiming this is just the beginning. Your own psychology will generate fear of missing out. Ignore all of it. Markets provide opportunities constantly. If you miss this one, others will come. The investors who succeed over decades are not those who catch every move. They're those who make good decisions consistently and avoid catastrophic mistakes. Missing a gamma squeeze is not a catastrophic mistake. Chasing an extended move with too much capital is. Let's be direct about the mistakes that can destroy your results in situations like this. First, over-leveraging. Using margin, options leverage, or concentrated positions to maximize exposure to a sector that just moved 8% is an invitation to disaster. Yes, if the move continues, you'll make more money. But if it reverses, you'll suffer disproportionate losses and potentially force liquidations at the worst possible time. Leverage amplifies both gains and losses. After a sharp move higher, the risk-reward of adding leverage deteriorates dramatically. This is when leverage is most dangerous, yet this is exactly when it feels most attractive. Second, emotional trading based on daily price action. If you find yourself checking prices multiple times per day, reacting to every uptick and downtick, modifying your thesis based on short-term movements, you've lost the disciplined mindset required for success. Day-to-day price movements in volatile sectors are mostly noise. They tell you little about the underlying value or longer-term trend. Trading based on this noise generates transaction costs, taxes, and poor timing. Third, abandoning your investment process because something worked. Perhaps you bought silver miners on a hunch without proper analysis, and they happened to surge. This does not validate the approach. It validates luck. If you abandon careful analysis and disciplined position sizing. Because undisciplined speculation worked once, you're setting yourself up for far larger losses down the road. Fourth, confusing a gamma squeeze with a fundamental change. A technical squeeze driven by options mechanics does not necessarily mean the underlying fundamentals of silver or mining companies have improved. It means the options market structure created an accelerant. When the squeeze ends, prices often retrace much of the move. If you've built an entire investment thesis around the assumption that an 8% day reflects fundamental value discovery, you're setting yourself up for disappointment. Fifth, ignoring risk management in favor of maximizing returns. Risk management feels boring when assets are rising. It feels like it's preventing you from making as much money as possible. But risk management is what allows you to survive the inevitable periods when your investments decline. The investors who build lasting wealth are not those who make the most during good periods. They're those who lose the least during bad periods and remain in the game long enough to benefit from multiple cycles. Sixth, listening to social media hype about silver going to the moon or miners delivering tenfold returns. These narratives emerge every time precious metals make a sharp move. They feel exciting and compelling. They're also usually wrong, or at minimum, early and prone to dramatic reversals. Base your decisions on analysis, not hype. Evaluate fundamental value, sector positioning, and your own risk tolerance. Ignore promises of imminent massive returns. Seventh, failing to take any profits after substantial gains. There's a psychological trap where investors become anchored to unrealized gains. If a position doubles, they can't bring themselves to sell any because it might double again. Then it gives back half the gains, and they still won't sell because they remember it being higher. Taking partial profits along the way doesn't mean you lack conviction. It means you understand that markets are volatile and that realized gains spend better than paper gains. Let me emphasize something crucial about gamma squeezes and explosive price movements. They create the illusion of a new normal. After a sector surges 8% in a day, your brain recalibrates. It starts to expect continued rapid gains. It begins to see smaller moves as disappointing. This recalibration is dangerous because it's not based on reality. It's based on a brief period of exceptional market behavior driven by technical factors that cannot persist indefinitely. Markets spend most of their time moving slowly or consolidating. The rapid moves are exceptions, not rules. If you recalibrate your expectations to treat exceptions as normal, you'll make increasingly aggressive bets chasing returns that may not materialize. Maintain perspective. An 8% day is extraordinary. It's not the beginning of 8% days every week. It's an outlier event that will likely be followed by much more mundane price action. Also understand that gamma squeezes can work in reverse. If put option activity increases and dealers need to hedge by selling shares, the same mechanics that drove prices up can drive them down just as quickly. Volatility works in both directions. The sectors that can surge 8% in a day can also fall 8% in a day. If you're not prepared for both outcomes, you're not prepared for what you're invested in. We've covered a great deal of ground today. The mechanics of gamma squeezes, the context of the silver mining sector, the psychological traps that emerge during rapid moves, the specific guidance for both existing holders and potential investors, and the critical mistakes to avoid. Let me bring this together with a few final thoughts. What happened in silver miners is significant, but it's not unique. Markets create these events regularly across different sectors and asset classes. They will happen again, the specific details will differ, but the underlying dynamics will be familiar. Your goal as an investor is not to catch every one of these moves. Your goal is to build a portfolio and a process that allows you to benefit from major trends while avoiding catastrophic mistakes. This means being positioned in assets you understand and believe in before explosive moves occur. It means maintaining discipline after explosive moves occur. It means protecting gains without abandoning positions prematurely. It means entering new positions patiently when opportunities align with your strategy. It does not mean chasing momentum. It does not mean over-leveraging to maximize short-term gains. It does not mean abandoning risk management in favor of excitement. The investors who ultimately succeed are not the most aggressive or the most clever. They're the most disciplined and the most consistent. They understand that markets go through cycles. They know that assets move from undervalued to fairly valued to overvalued and back again. They position accordingly, taking profits when assets are expensive and accumulating when they're cheap. They manage risk as carefully during good times as during bad times. They size positions appropriately. They don't let any single investment, no matter how promising, dominate their portfolio to the point where a reversal would be devastating. And perhaps, most importantly, they maintain emotional equilibrium. They neither panic during declines nor become euphoric during surges. They treat both with the same level-headed analysis and the same commitment to their process. This is not easy. Your brain is not wired for this kind of discipline. Evolution optimized you for immediate reaction and strong emotional response to threats and opportunities. Those traits helped our ancestors survive, but they work against you in financial markets. So you must build systems and habits that override these natural tendencies. You must create rules for position sizing, entry points, exit points, and risk management. And you must follow these rules even when, especially when, your emotions push you in a different direction. The 8.3% surge in silver miners will be forgotten within months. The lessons it provides, if properly absorbed, will serve you for decades. Let me leave you with specific action items based on where you stand. If you hold silver miners, review your positions this week. Calculate your current allocation. Determine if it's still appropriate. If you've made substantial gains, consider taking partial profits or implementing protection. Update your exit strategy and prepare yourself mentally for increased volatility ahead. If you don't hold silver miners but are interested, resist the urge to act immediately. Put the sector on your watch list, study the companies, understand the fundamentals, wait for consolidation or pullback. When you do enter, start small and scale gradually. If you're not interested in silver miners at all, use this event as a learning opportunity about market mechanics, investor psychology, and risk management. The specific sector doesn't matter. The principles apply everywhere. For everyone, regardless of your current positioning, commit to improving your investment process. Identify the weaknesses in your approach, whether it's emotional decision-making, inadequate risk management, poor position sizing, or insufficient analysis. Make a plan to address it. The market will test you again. It always does. The question is whether you'll be prepared. Markets are neither your friend nor your enemy. They're complex systems that process information, allocate capital, and reflect the collective decisions of millions of participants with different goals, time horizons, and constraints. Your job is not to outsmart the market. Your job is to participate intelligently, manage risk prudently, and remain in the game long enough to benefit from time and compounding. Some days will feel exhilarating. Others will feel frustrating. Most will feel boring. All are part of the process. The gamma squeeze in silver miners is now history. What matters is what you learned from it and how you'll apply those lessons going forward. Stay disciplined, stay patient, stay focused on what you can control, let the market do what it does, and build your wealth over time through consistent, intelligent decision-making. That's how lasting financial success is achieved. Not through spectacular gambles that happen to work, not through predicting the unpredictable, but through discipline, consistency, and an unwavering commitment to sound principles. The opportunities will keep coming. Make sure you're still standing when they arrive. Thank you for your attention today. Until next time, invest wisely.